Good morning, everybody. Good morning. My name is Stacy Schell. I'm a partner at Rothstein Cass in our hedge fund group. Rothstein Cass is the premier accounting, tax, and advisory firm. And what sets us apart from other firms is that the majority of our time and resources is dedicated to the alternative investment industry. We are thought leaders in this space, and we have the expertise to provide practical solutions and timely answers to our clients. And those are just a few reasons why Hedge Fund Review recently named Rothstein Cass as the top accounting and audit firm in the nation. This morning, we have two terrific interviews, one from the investor perspective and one from the manager perspective. First, we're going to have an investor take the stage. Interviewing our first keynote this morning is Jeff Goldfarb. Jeff is the assistant editor with Breaking Views. He focuses his coverage on Wall Street, private equity, M&A, and the media industry. Please help me welcome Jeff Goldfarb. Hi, Jeff. Now, Jeff will be interviewing Matt Botein. Mr. Botein is the co-head and chief investment officer of BlackRock Alternative Investors, where he oversees $110 billion spread across BlackRock's hedge funds, private equity, both hedge and private equity fund-to-funds, opportunistic funds, real estate, and real assets. Prior to joining BlackRock in 2009, Mr. Botein was a managing director and member of the management committee at Highfields Capital Management, a Boston-based private investment partnership. Previously, he was a member of the private equity departments at the Blackstone Group and Lazard Frères. Mr. Botein earned an AB degree, Phi Beta Kappa, magna cum laude from Harvard College, and an MBA degree with high distinction from Harvard Business School, where he was both a Baker Scholar and a Loeb Scholar. Mr. Botein?
Thank you.
Thank you. Enjoy the show.
Thanks, Matt. Good to have you here.
Good to be here. Tough to go on after a late night and before Bill Ackman.
Hopefully the coffee will get the synapses firing here soon. I want to kind of dive right in. Obviously, we have limited time, so dive into an issue that goes to a little bit about what BlackRock's philosophy is, while also touching on a big issue I think that the alternative asset community is facing, which is the whole issue of fund-to-funds. The value proposition for the whole model seemed to come down significantly after the crisis. You've kind of taken that head on and come up with a different way of looking at it. Can you talk about broadly the dynamics for the whole fund-to-funds model, really?
Sure. Jeff, we engage in both direct investing and indirect investing through our fund-to-fund operations. In the fund-to-fund business, I think that the model necessarily has evolved a great deal over the years since the crisis, but frankly leading into the crisis as well. The industry used to be characterized as a 1 in 10 extra layer of fees for access.
And justifying that seems
justifying
to get harder.
Well, it got harder as access became easier. And as many of the larger, more sophisticated investors in the fund-to-funds came to possess the capability to invest directly in at least a subset, an important subset, of managers themselves, particularly, again, once those managers became open to them. And so what we've done, and other leaders in the fund-to-fund business have done, is to significantly evolve the fund-to-fund business from being a typically commingled, all-in-one hedge fund access product, or private equity access product, in the case of our private equity fund-to-funds, to being typically a much more customized approach to investing with a specific objective in mind for the investor. So if you look at our hedge fund-to-funds business, most of the flows that have come into that business over the last 5 years have been into customized separate accounts for actually very sophisticated investors who have their own direct investing capabilities. They'll go into Bridgewater themselves, they'll go into Perry themselves, they'll go into the now household names in the hedge fund industry on their own. Likewise, on the private equity side, they'll go into Blackstone themselves or KKR or TPG. But for very specific tactical objectives, they'll work with us in fairly large size, In the hedge fund case, a common occurrence is a client who will work with us to design an emerging managers program. So they'll have concluded that they can invest in established managers themselves, but they can't find the next generation. Or emerging markets. They can work in developed markets themselves, but they can't find that great long-short manager in Brazil. Or commodity strategies. They can find global macro and multi-strat themselves. They want to have exposure to the commodities alpha streams. We help work with them to complete their hedge fund portfolio in a very customized way. On the private equity side, very common programs that we're working with partners on would be co-investment. So they've invested heavily as LPs in funds. I'm sure we'll talk about fees at some point. Those fees have been sticky. The way that the larger investors have gotten the benefit of their bargain is by securing co-investment rights, but most are not staffed to be able to actually respond when KKR says, would you like to put $100 million into this oil deal with us, or this gas deal? And so we work with them on their co-investment program. Or
So
we work.
is paying for access then kind of is that gone, or is that going to come back? Is that how, what do you?
I think paying for access as the principal justification of an industry is gone. I actually think over the course of 2013, in certain sectors, we're going to see access become more limited again. With the flows that have come in and with the capacity constraints that certain managers do have, I do think we'll see unequal access to certain managers emerge, not writ large, but for many of the managers that we like the most.
Okay. Let's talk about the flows a little bit, because I think in particular in hedge funds, the trend line on returns broadly in hedge funds is down, and yet assets keep going up. How do you think about that phenomenon, and does that make the job harder, easier, the value proposition stronger for you?
I think that it's premature to draw a conclusion about the secular return prospects for the hedge fund industry. The last couple of years have caused some discouragement. People point to the reattainment of the $2 trillion asset level. Likewise, you could point out in response the dramatic reduction, something like 55% of investable alpha-seeking assets having been reduced, driven by 90% plus coming off of the prop desks. So you could argue back and forth about the real underlying secular drivers. You can't argue about the results. I personally think some of that has been driven by the high correlations that we've seen as headlines have driven so much of the markets in recent years. The other thing I'd say is everything's relative. If I told you in 2003 that the return that you would make on a diversified portfolio of alternative managers, hedge funds, private equity, real estate, and real assets over the next 10 years would be 9.3%, you might shrug and be a little bit unimpressed. If I told you that stocks were going to do 2.5% over the same period, including dividends, that would look pretty good. Private equity did actually beat the markets by 500 basis points on average, and 1,900 basis points for an upper quartile fund. So there is a bit, in my view, of everything is relative, and it depends on what happens in the world.
One small item related to hedge funds as well. Is the headline risk at all a factor from what we've seen, whether it be Rajaratnam or SAC or just the crackdown on insider trading? Is that affecting the way you think about the business at all?
Not really. I think that there are so many thousands of hedge funds. You take thousands of anything and you get some bad actors not commenting on anyone in particular. I do think what will happen is not allocators deciding not to invest in hedge funds, but I think the processes they go through, the diligence and the oversight and their use of partners, whether they're consultants or fund-to-fund managers, hedge fund solutions partners, I think you'll see increases in those activities so that there's coverage for the unexpected.
Okay. And on the returns that you mentioned, obviously, the spread makes alternatives still compelling, but on a sort of a whole basis, on a holistic basis, have investors digested that returns in alternatives will come down? I mean, the relative basis maybe is a different proposition, but
I don't know. Investors haven't universally digested that returns in traditional investments are going to come down. We're sitting in a 2% interest rate environment, and there are people you will talk to who will tell you how safe bonds are. There are pension plans you'll meet with who will tell you that they're going to make 7.5% over the next 30 years. These are not dumb people, these are smart people. But they're smart people who face very serious governance constraints, political constraints. So in the discourse, it's not at all clear to me people have digested that returns, not just in alternatives, across the board are going to be lower over the next 10 years, at least in real terms. What I'd like to see more of, that I think would be the most constructive, would be if we could stop talking in terms of buckets and expected returns, but talk more in terms of risk and expected returns. I think when we talk to investors about their illiquid portfolios, one, we think they're too small, that most investors have capacity to access more illiquidity premium than they're doing. But two, they should be much more careful in assessing what risks they're taking in all of these buckets and demanding returns, looking for returns that are commensurate with the risks as opposed to the asset bucket.
And so you don't feel like that adjustment has been made, or I mean?
Not fully. When you talk to people about investing in lower risk infrastructure strategies, many will say, well, it's illiquid or it's long dated, so I need to make 15%. Now 15%, if you're taking private equity risk, which is levered beta plus alpha, may be a perfectly appropriate return target to have. But if you're not taking that level of beta along the way, the return target probably should be lower and still allow for a very significant excess over the liquid alternative.
Okay. What about, and when you talk about risk and trying to gauge it, macroeconomic risk always plays a factor. Is it more of a factor now? Has it been over this last span and going forward in the calculation? I mean, things like Cyprus seem to, whatever it may be, the fiscal cliff, I don't know, whatever it may be, it seems like it's harder and harder to overlay that on anything because it's seemingly irrational a lot of the time.
It can make security selection more, the macro is very important, right? Not only the headline risk of Cyprus, but here in the US, I think there are some macro factors that are assuming that we can get out of our own way politically on our budget, big assumption. But if we can, the macro factors here are unbelievably compelling, unbelievably positive.
Why?
Cheap energy, capable labor, many reasonable labor regimes. I met recently with a large German manufacturer who was actually relocating one of their major factory activities from the heartland of Germany to South Carolina. And they're doing it because there's a reliable labor force that's well-trained. The infrastructure of our country we all complain about, but it basically works. We complain about tort lawyers, but you basically can conduct business in America. And he's going to run his factory on $4 gas instead of $12 gas supplied by Russia. So there's some really good fundamentals that I think will drive our whole economy if Washington can get out of the way. Within that, picking the right securities, which is the job of many of the people here, is hard to be proven right on in the short term. But I think that there are going to be clear winners that emerge from this, clear losers that emerge from this, and good hedge fund managers and good private equity investors over time, right, I think are going to demonstrate superior return.
Let's talk about one of the big specific risks, which is rates. Ray Dalio said in December that his best guess was that rates would start to turn up later this year. I don't know if Ray has changed his thesis or not, but the other point he made was that it'll be a fairly seismic moment for people that in the investing community, for obvious reasons. What's your thesis?
I don't want to answer on behalf of BlackRock Incorporated. I'll leave that to Larry and Peter Fisher and much better prognosticators on interest rates. But you just look at the math, and if you own a typical corporate bond, if interest rates go up by 16 basis points, you make no money for the year. If they go up by 17 basis points, you lose money. And if I were to look at the over-under or the distribution of potential outcomes, I don't own any bonds in my portfolio. And there are so many better places to put money from a risk-return standpoint than to put them into bonds.
Let's go to private equity a little bit. We've seen some creative ideas come out of the Texas Teachers Fund. New Jersey has done some interesting things with Blackstone, where you used to be. Why don't we see more of that? These kinds of, either cross allocation in exchange for lower fees, whatever the model winds up being. It doesn't feel like we hear enough about more creative approaches to that. Are they happening, or should they be happening?
I went to a dinner the other evening, and Larry Summers spoke, and he was speaking in the context of global affairs, more so, and the macroeconomy more so than private equity fund terms. But he made the point that everything in life takes longer than you think, and then once it starts to happen, it happens faster than you could imagine. And I think we're still in the longer than you would think phase. So everybody knows it doesn't make any sense, as funds have grown from $500 million to $10 billion, that the fund terms haven't changed. But there are very few people with the conviction and the confidence to move first and say, as New Jersey and Texas have, we're not going to invest unless you do something different. They've moved, and I think lots of people that we talk to are looking to follow. And I think over the next couple of years, we're going to see significant movement in the direction of greater creativity. And I don't think it's just fee slashing. The reality is, if you're a good private equity firm, you're worth the money. But I think you're going to see differences in many of the other terms and the arrangement of activity towards better partnership.
What becomes the catalyst? What gets us to the point where it happens so fast that it surprises us? In other words, what's going to, just people mulling it over and getting to that place? Or
I think it's the re-ups, the leverage of the re-up, and certain investors saying, if you want my $400 million re-up, here's what I want. And again, I think it's not going to be, I want 75 basis points instead of 150, and I want a 10% carry instead of 20. It's going to be much more nuanced than that, I think. It's going to be, I want to work more closely with you. I want to co-invest more with you so I can control the pacing, the timing, the industry selection, so I can have more of a role in the construction of my portfolio. It also will bring down my effective cost of investing, because to the extent that I take up co-investment, my average cost comes down. I think we're seeing this trend towards more customization and more of a solutions approach beginning to play out to a very major extent in our pipeline and our new business. So whereas we used to be talking to clients principally about a product here, a product there, the most recent mandates that we've won have involved 9 and 10 figure amounts of money, which go across multiple strategies, across many different managers. And what we're looking to do is, in partnership with a client, solve a specific problem. Again, whether it's completing their hedge fund portfolio or optimizing across public and private market exposures, doing so in a manner that respects liquidity and timing, and doing so in a manner that respects and can accommodate what they have going on elsewhere in their investment portfolios.
Is there, these kinds of negotiations and coming up with creative, tailored solutions maybe, does it speak at all to how the balance of power maybe has changed between LPs and GPs, whether it's private equity or other asset classes? Can you talk a little bit about that? Because it felt like, again, post-crisis, it seemed like the equilibrium was changing. Has it gone back? What are you saying?
I think in the history of the business, there's typically an exaggeration and an overestimation of how these changes occurred. In the crisis, people thought the formation of industry associations, the leverage that LPs would have would completely reshape the industry, and managers would take vows of poverty, and we'd all sing kumbaya. That isn't going to happen. But I do think that the tone of the dialogue has changed, and it's become more partner-like. There is this word partner in the term partnership agreement, limited partner, general partner. I think people are beginning to behave more like partners. And you can't forget, the investors do need the return. So for a hedge fund manager who's really good, we have some in the audience, for a private equity manager who's really good, the investors need them. The investors need them because, as we said before, Our public pension plans have said they're going to make 7.5% over the next 30 years. They're not going to get there by owning bonds. They haven't gotten there by owning stocks. So investors, while everyone wants a better deal, need the skills of the managers. I think the real objective should be to harness them in a more constructive way.
All right. All right, I'm going to throw down a real challenge for you. We're going to see if you can talk about regulation without putting everybody to sleep. But I mean, I think it's an important issue because whether it's the marketing rules here or it's potentially compensation restrictions in Europe, it feels like, and you can speak to this, that the industry is confronting more regulation maybe than ever. And what does that mean? How do you think about that? Put that into your risk modeling, all the rest of it.
Well, there's no doubt we have more regulation. Everyone's seen the stack graphs of the length of the Securities Act of 33 and Investment Companies Act, which are like got this tall, and then you've got Dodd-Frank, which is like taller than this building. And so we have more regulation. I think when you step back and look at it, the balance of that regulation will prove to be an unmitigated positive for institutional and retail investors. Because what that regulation is going to have the effect of doing is going to be to drive good investment opportunities that used to live in the large financial enterprises out of the large financial enterprises. And this is one of our major investment themes for the next couple of years. So whether that regulation is Dodd-Frank and its effect on the U.S. banking system, or whether the regulation is Basel III and its effect on the capital requirements for global banks to hold different types of assets, the effect is going to be to chase hedge fund-like strategies, many different types of lending strategies, many types of assets that are so-called bad assets like mortgage servicing rights. Those are all going to be chased out of the banks where, with a lot of leverage, they drove most of the profits. They're going to go somewhere, and they're going to go into accounts that people manage for institutional and retail investors. So that's the good news. The bad news is it's an unbelievable amount of work, and it's incredibly complex. We file now in Europe, or we will be filing in Europe now, for any fund that we might offer in Europe. We have to file a set of forms in every language for every fund where that fund might get bought. So when you look at AIFMD, when you look at Form PF, when you look at all of the many implications of Dodd-Frank, the compliance burden of it is very high. I'm not making a value judgment about whether it was deserved or is worthwhile, but it's very, very high. The effect that will have is to erect increasing barriers to entry in our business. We can manage, many of the people in this room can manage having to file thousands of forms in Portuguese. But
not everyone can.
But a $250 million hedge fund can't.
Well, that gets to another issue, which is one of scale. We've certainly seen over the years a few managers like Stan Druckenmiller say, it's too big, it's too much, you can't really do anything. Certainly BlackRock knows a thing or two about scale and size. How do you approach that issue, given what you just talked about? And it seems like there may be more concentration if little guys are going to be shut out for regulation or other reasons. How big a factor is that in your?
Well, there are times and there are segments where scale's an advantage. If you're sitting down with a European bank that is motivated quietly to make some of its problems go away, to risk transfer assets, to exit certain origination activities, to sell other assets, they want to do it quietly and they want to announce it's done, scale's an advantage. When we had the PPIP and the TALF programs, and there was a race against time to deploy capital into the eligible ABS, having people who covered every QSIP was a real advantage. When you have to deal with the back office functions, the regulatory functions, the accounting function, scale's great. That said, we're also completely aware of the empirics, which show that for many strategies, especially fundamental hedge funds, that there's a negative correlation between scale over a certain point and the results that are realized over long periods of time. What we try to do is match the positive scale activities with large-scale funds and the negative scale activities with small funds. So in our hedge fund business that we run on a direct basis, our average hedge fund's about $1 billion in size. So we're not as big as we seem, but the data is pretty unambiguous in the hedge fund industry that there's not a positive investment effect to larger fundamental hedge funds.
Okay. Well, we certainly saw some of it, I guess, in terms of buyout funds. I mean, it seems like they maybe hit a threshold as well, but it's...
You know, in a moment in time, their scale was a big advantage. When there were only a couple, I remember I was at Blackstone at the time, when there were only a couple of mega funds and they could corner the deals and they could get the financing, scale was actually an investment positive for them. When there were more of them, and then when the financing became harder,
Right.
those positives were arguably somewhat dissipated. There are other strategies where you can't make a blanket statement. In activism, I think there's probably a pretty good argument that scale above a certain point is helpful because it gives you a greater likelihood to drive change.
I'm sure Bill will be happy to know that.
I don't think he has to worry about a change of scale.
Let's talk about one other asset class that you kind of look after, which is real estate, really briefly. You know, it seems like a lot of smart money these days has very high conviction on U.S. residential. Are you among that group? Are you more persuaded by U.S. commercial, European? You know, how are you thinking about the?
But the tale of many markets, right? There's not a lot in common between city center, fully leased office properties and housing in the Sun Belt, single-family housing in the Sun Belt. So you really have to think very micro. Having said that, I am pretty bullish on the residential sector in the U.S. If you look at the valuations of housing stock on average, it is significantly cheaper to buy a house than to rent a house. And so that is likely over time to equilibrate, likely in the form of some combination of higher rates and higher house prices. And I think we're beginning along that trajectory. We started a business called PennyMac, which is a distressed residential, now evolving into performing. So we see it at a pretty micro level. I think part of what's held back appreciation relative to what the models should tell you should have occurred, will tell you what should have occurred, is that access to capital, access to loans is so uneven. So housing is dirt cheap if you qualify for an FHA or a conventional mortgage loan. But if you don't, it doesn't matter because you can't get it. And so I think that's depressed the price of housing relative to where interest rates should tell you, incomes should tell you that housing should be. So I'd be pretty constructive on owning a basket of residential real estate. There are some specific challenges to owning it for rental because it is much more challenging and expensive to administer, to property manage a decentralized portfolio of single-family homes than multifamily. And so there's a lot of special sauce to get that right, I think, and not everyone will do that right. In the commercial side, I think it's a tale of many markets. The super prime, fully leased New York City office building, to me, is a relative value trade gone awry. People are looking at that as at a 4.25 cap as being 200 basis points over treasuries, but they're not shorting treasuries against it. And so I think I wouldn't have the degree of confidence that I think others have, that that's going to be okay, that as the economy improves, rates won't go up until rents also start to go up. That's the bet people are making. But you step off of Park Avenue in the commercial world, and there are, I think, very interesting opportunities still in real estate equity land. I also think there's some really great opportunities in real estate debt land owing to the withdrawal of the banks from anything that looks risky. So one of our favorite areas right now is mezzanine real estate debt, where you can sit, in the 55 to 75 LTV on an office building, and the debt beneath you is making 4, and the equity is making 4, and you're making 10. So you have to be very careful about your region, your piece of the capital structure, the type of property. But we do see generally opportunities. Okay.
And beyond real estate, we've only got about a minute or two left. I just want to wrap up with where else are you seeing the best opportunities right now to invest?
Our two big themes are go where the banks can't or won't. So that's areas like real estate, debt, mortgage servicing, rights, direct lending in Europe, or bearing illiquidity when people are still averse to doing it, particularly for very long lockups. So in the renewable power space, where we're going to build over $1 trillion of wind farms and solar farms over the next 20 years, and those wind and solar farms are going to be on offtake agreements that look a lot like fixed income, the yield that we see attainable from owning those wind farms subject to the power purchase agreements or owning the solar farms is well in excess, like double what investors can earn by owning the structurally subordinated but more liquid bond of the parent company. And it's not just we feel this way. Buffett is going to end the year owning something like 14% of all of the wind farms in America. So people who have illiquidity to commit, and I think there are more of them than who raise their hands, could do really well owning some of these illiquid assets.
Great. We will leave it there. Please join me thanking Matt for his time.
Thanks, Jeff.